What's good, family? Dub Washington here, and what I want to break down to you today is the perfect credit profile. And I got to be honest with you, family. There is no such thing as the perfect credit profile. But while I have you here, I'm going to show you how to get as close to the perfect credit profile as possible using the updated data points that the banks actually care about. But while I have you here, listen, I need you to understand that the goal is bigger than just getting approved for another 5, 10, or even $20,000. Like, if your goal is to eventually build a profile capable of accessing six figures, multiple six figures, and potentially over $1 million in funding, this is what I need each of you to understand. A high credit score by itself is not a funding strategy. You can have a 780, you can have well over an 800 credit score and still be denied for funding. And a lot of people don't understand that. A lot of people don't realize it whenever it happens to them. But there's a multitude of factors that banks are looking at you from. Risk mitigation, how lendable are you? Like, what is the lowest perceived risk or highest perceived risk type of profile that comes across the desk? All these things you got to understand, right? And somebody else with a 620, somebody with a 640 can walk into that same exact bank and leave with way more money. They can leave with a $50,000, $60,000 approval, all because they understand banking, right? Because the most important thing I need you to understand is lenders aren't only evaluating your score. Does everybody understand that, right? I need to make sure everybody is in one accord whenever I'm breaking this down. They are evaluating your profile. And today we're going to break down a few things. What's the strongest credit profiles look like going into Q4 of 2026? What I would absolutely stop doing if funding is my objective, right? What's changing inside of lending and banking? That's super important because based on the lending climate, you can kind of dictate what limits that we should receive based on what they are giving out, let's just say potentially to the masses. You see what I'm saying? So we're also going to break down some utilization versus actual credit usage, the account age, like true authorized users. All of these things we're going to break down tonight to help each and every single one of you get into a better position going into Q4. Listen, family, we need to be structuring a Q1 strategy for 2027 right now while we're in Q3 to make sure we're positioned because it's right around the corner. We have less than 6 months. We're going to be in Q1 of 2027. And what banking relationships have you currently been building? Like, that's super important. And towards the end, I'm going to show you something that I think most credit educators completely miss. Like, difference between building a profile for a credit score and building a profile for funding, right? There's a big difference there. Those are not always the same thing. So let's jump into it. I really want to talk about the lending environment that we're currently in right now. Before we build the perfect profile, we have to understand the environment you're building in is super key. And here's what I want everybody to understand. Going into Q4 and Q1 of 2027, it's not essentially as hard as you think it is to acquire funding at this current time. But you cannot approach banking the way that the masses is approaching banking. And this is where people get frustrated. They'll say, the banks are not lending anymore. That's not completely accurate. Banks are still lending. The better question is, who are they lending to? Under what conditions and what characteristics are they rewarding? All of this fluctuate in a lending cycle because lending standards aren't identical across every single product. Credit cards can be tightening at one institution, right? Lines of credit could be tightened at a different institution. One lender may hate your profile while another lender views you as their ideal customer. And that's where I continuously tell people, stop looking at the credit as one giant system. You're dealing with individual financial institutions that have either different risk appetites, different internal policies and exposures, the product priorities, geographic priorities, exposure limits, underwriting models, all of these things, we are essentially, how do I want to put this? We are essentially throwing a rock hoping that it falls in a ring inside of an ocean. Whenever you don't understand there's so many different nuances and strategies to get access to high limits. Sometimes it may not be best for you based on your profile to go to a national institution. That's why we build with small credit unions and community banks. So if you want to do the opposite of what everybody else is doing, first you got to understand what everybody else is doing. So the masses are chasing approvals. I'm trying to teach you how to become approvable. Like there's a complete difference. So here's my objective with this video, or here's my objective with this strategy. I'm not physically going to walk inside the bank with you, but I am going to walk you to the bank. Meaning by the time you submit that application, I want everybody to understand what that institution could potentially see when they look at your profile. Because I got a 750 is not good enough. That's no longer good enough. Like, let's go deeper. Imagine I'm the lender. I want you to know how you have handled the credit that you've already been given. Like, how are you managing the money? How are you managing the bread? How are you managing the access of availability of the capital? How much available revolving credit do you currently have? How much of it are you using? How many accounts are carrying balances? How quickly have you acquired any new debt? How old are your accounts? Listen, are the primary accounts on your profile comparables, true comparables, authorized users? Are you leveraging a whole bunch of AUs, or do you have primary accounts? Have you demonstrated experience managing installment debt? Are you seeking new credit? Like, all of these things are super important. Like, what's your repayment history? What's your income? What's the business revenue? What's your repayment history? What's your cash flow? What's the deposit activity? All of these things are super important. So I say all of that to say, coming into it, we have to understand that the level in which you understand the game will always be the level in which you play. We understand banking on a different level. So let's start with some personal loans. Personal loans, like, they aren't necessarily bad. You do have some legitimate reasons to have a personal loan, like debt consolidation, home improvement, like you got major purposes, unexpected expenses. All of these things can be like valid reasons for it. And the underwriter isn't only looking at the existence of the debt. They're trying to understand the story behind the debt, because if you're not leveraging debt, you're still a high risk. So if I'm preparing for a major funding sequence and my profile suddenly shows a personal loan, another personal loan, a high revolving balance, I got some new inquiries, several new accounts just hit the profile, you have to ask, what story does the combination tell? Potentially, this customer may need liquidity. And that's different from this customer has access to capital and responsibly manages it. It doesn't mean that every lender is going to look at your profile and think the same exact thing. But this entire strategy is about eliminating the unnecessary variables before we go through on that application. So another thing that we must talk about, y'all notice that I haven't really got into the data points yet. I promise you I got you. We got to look at the look back concept. Like, this brings me to something that I think a lot of people skip over and they need to take more serious. Like, your recent behavior matters. I call this, like, banks kind of coined it, a phrase as the look back period, but I would call it like preparation. Because different lenders use different underwriting models. So I'm not telling you there's some universal 60-day or 90-day banking rule. But what I am telling you is this how I would personally prepare, right? If I know I'm going on a super important funding sequence, I'm looking backward before I move forward. 30 days, 60 days, sometimes even upwards of 180 days. And what does my recent profile communicate? Have balances suddenly spike without a large pay down? Have I opened up multiple accounts? Have I generated unnecessary inquiries? Have I been applying to random institutions? Like, have my statement balances have been consistently elevated? If I'm used to using only $10,000 or $5,000 on a particular card, now I'm going up to $25,000, $35,000, right? And not paying it down in full. Did I suddenly pay everything down yesterday because I'm applying tomorrow? Like the banks are not as slow as we think they are. I would rather walk into the funding window with the profile like already being positioned. If I'm making sense, I need y'all to drop a 1 in the chat. If I'm making sense. Because I never want to talk above or below where anybody is at. And I know we got a mixed room tonight. So what I want to do is make sure that everybody is getting value. And that's why, which takes me back to my original point, that's why I like a rough 90-day preparation runway when possible. Not because the lender has that 60 or 90-day rule, but because funding should be prepared for, not improvised. So whenever you are preparing and going for a funding sequence, right? This is pretty much how to develop the profile to look perfect. Let's talk about the utilization. This is where most people misunderstand whenever I'm talking about utilization. If I'm preparing for a funding round, I want my revolving utilization to be controlled. I don't want my cards that's reporting to the business credit or the personal credit bureaus to be maxed out. I don't want a bunch of accounts sitting at 60, 70, even 80%. Why? Because high revolving utilization can signal what they call overextension of credit. But don't turn what I just said into Doug said never to use your credit cards. That's not what I'm saying. This is one of the biggest misconceptions about credit. There is a difference between using credit and reporting excessive debt. There's two different things there. And those are complete opposite ends of the spectrum. So this might be one of the most important sections that we're going to jump into tonight. But people say keep your utilization at 0. I say absolutely not. Right? Then they take it to the extreme. They'll get approved for a $20,000 card, put it back in the sock drawer, never touch it. Another 30 card, never touch it. Another 20 and never touch it. Bro, that's not what people are doing. Eventually you build a profile with high revolving balances, but you have no demonstrated activity. Yeah, does that make sense? Who gets a credit card and never uses it? Like some people get high limits and only let it report. Like, bro, that does not make sense. You have to have pay down periods and you have to show the utilization of the capital. So I want low utilization. I don't necessarily want zero financial activity because even FICO will tell you, whenever you're going to look at your FICO bank card score, it'll tell you that if you use some of your credit, your credit score actually goes up. I went from 0% utilization to like 6% and my credit score jumped like 8 or 9 points because they want to see the activity. So this idea that every card has to be reported $0 every month for you to have an excellent profile, that's not true at all. Your objective is responsible usage. So we charge normal expenses. We let the institution see the activity and then we pay the debt. We pay the obligation. We control the reported balances and then we rinse and repeat this cycle. This is creating a payment behavior and banks love data. Like all the credit bureaus, all the banks are data furnishers. How would I say it? They're just presenting data for lack of better words. Because every transaction gives them information and every payment gives them information. Every statement gives them information. You are developing a financial history, and that's especially important whenever we're talking about relationship building. And this one right here is like super, super key. Access to credit is not the same as experience with credit. Let me explain this like extremely simple so we understand this. Imagine two people. Person A has $100,000 of revolving credit. They barely use it, very limited activity, little payment history across those lines. Now, person B also has 100 available. Regular spending on a card, low utilization, anywhere from 6 to 10%. Monthly payments, they got a great account history, no missed payments, and consistent behavior across these cards. Which profile gives a lender more information? Y'all let me know. Which lender has more information on that particular consumer? Person B. That's why I don't teach people to just worship the limits. I want limits accompanied by demonstrated usage or demonstrated management of it. Because funding isn't about collecting credit cards like the gold trophies. You're trying to build evidence that you can responsibly have pay down periods and you can manage larger and larger amounts of capital. That is the entire framework behind everything that I teach. Please understand that. And we got to get into the factors of the profile because I want everybody to understand this. Payment history is non-negotiable. Like, I think this should be obvious, but I have to say we should have no late payments. But if you do have a late payment, I have to say this, after 2 years, they're not as impactful. Anybody on here tonight have a late payment over 2 years old and you still have an 800 plus credit score and you still been able to get access to capital? Because it takes 24 consistent payments to handle, or let's just say outweigh, one late payment, one 30-day late payment. So if we're talking about getting as close to that perfect profile, payment history needs to be 100%, right? It's the largest factor of your FICO score. And this is why I say, before we talk about the 250s, the 500s, before we talk about $1 million sequences, can you consistently pay a $500 obligation? Can you manage a $20,000, $30,000, $50,000 credit card? Because the lenders are essentially saying, how have you stewarded what you have already been given? Man, can I take you out of church right there? Man, we're not going to do it. We're not going to do it. But how are you properly stewarding what you've already been given? That could apply to your spiritual life. It could apply to your physical life. It could apply to your financial life. It could apply to your mental health life. Listen, man, anyway, let's keep it here, Doug. If your existing obligations are, I would say, if they are not being stewarded properly, that's that word again, adding additional leverage doesn't solve that problem. It essentially magnifies the problem. So once again, we got, what did we just go over, y'all? I'm losing my train of thought here. There we go. Payment history. Next, we want to go to the profile age, right? Super, super important. I think a lot of people skip over this, but strong profiles generally benefit from seasoning. Like, time gives lenders more information, and then the FICO evaluates your profile as the age of your oldest account, the age of your newest account, and then it's the average between the two. You know what I'm saying? Like, that's just really a quick breakdown. But we can bypass having low age with building deposit relationships with the banks. You see what I'm saying? So sometimes you can have a very thin age, but what ends up happening is you're able to build a deposit relationship with the banks. And from there, they trust you a little bit more because they've leveraged the deposits that you've given to them, right? And this works amazing with credit unions also. So this is where authorized users can become like super powerful. But remember, family, we do things different from the masses. We do things a lot different over here, and AUs are not as efficient as most people think. They are great for age. I have to say that. If you need age, you can go buy a 15-year-old AU account if you have been denied for age, which let me go back to that real quick, y'all. Don't just assume because your age is 1 year, 2 years old, that you're going to get a denial. Apply. Let them give you adverse action to say that, hey, you're being denied due to age of your accounts. Let them tell you before you just assume. You know what I'm saying? So people will think, I need age to let me go buy a 15-year-old AU account. And maybe the account reports and your score will go up. Your age will improve. But here's the question that I want you to ask. Does that suddenly create 15 years of your own borrowing experiences? No. You borrowed somebody else experiences, their pay down periods, right? So you weren't contractually responsible for that debt, and it's going to list it on the actual your consumer report. Whenever it says account type, it'll put authorized user up there. And a lot of the newer FICO models, they treat AUs differently than they treat the primary accounts. So once again, I do want to say, if you're looking solely for age after a denial, an AU will actually help you. You know what I'm saying? But an AU is not a substitute for developing strong primary trade lines on your own. So Please understand that the primary history matters. So please understand that part. I don't want somebody with 3 months of actual personal credit trying to go and get a 20-year-old AU suddenly makes them look like a 20-year borrower to every financial institution. That is not what we doing. Credit scoring and underwriting are more sophisticated than that, family. I think we passed that. Now, what I prefer buying over age is like what we just talked about. If I check it, if you're starting from scratch and you say, Dub, how do I build a strong banking profile, a fundable banking profile? I'm going to start looking at relationships. Find institutions that actually fit like your long-term strategy. Open the appropriate deposit relationships, and then you want to route your financial activity through that. Learn the products, learn the underwriting, allow the relationship to season, and then you graduate through products appropriately. People underestimate deposit relationships because they're searching for shortcuts. But if you think about in 36 to 48 month windows, your thinking changes. You're no longer asking, how do I get $50,000 on Friday? You're asking, how do I position myself with multiple banks to go and get access from 50,000 from each one of them over the next 4 years? That's what we call wealth building thinking. Am I making sense here? And listen, and this is where we get back to the title, the perfect credit profile. There isn't one. Because the perfect profile for a mortgage application isn't necessarily identical to the perfect profile for a credit card strategy. Am I making sense to anybody? The perfect profile for an auto loan isn't identical to the perfect profile for a business line of credit. Different products analyze different variables. But what we're trying to build is what I call a bankable profile, one that gives us options. I want strong payment history, controlled debt, strategic revolving usage age, true primary true primary accounts, installment experiences where appropriate. And then we want to limit unnecessary new credit. We're building out funding sequence super strategic. And another thing, upon talking about this, like we got to get with the credit mix. FICO evaluates different categories of accounts. You got auto loans, you got mortgages, you got personal installment loans, you got student loans. Credit mix represents like a small portion of that FICO. But listen, you can put yourself in prime position from the small things that people are not paying attention to. So don't misunderstand me. I'm not telling you to go into unnecessary debt just to improve your credit mix. That don't make no sense. You don't need to take out a 12% loan and pay $1,000 in interest because somebody on Instagram said you need an installment loan. That's a horrible financial strategy, by the way. But if your profile is thin and you're building credit history intentionally, there are products that can provide installment experiences without taking on unnecessary debt. And that's where we talk about like the pledge loans, the shared secured loans. And if you haven't, if y'all hadn't heard about that, actually just go to my YouTube. I got a breakdown on it to where I talk about how to properly leverage shared secured loans. And then actually what I'll do is, if y'all listen, what I want everybody to do is text. Well, we're gonna get something super special for y'all tonight. Text bank, right? Text bank to 864-721-8750. And then what I'll do is send you a list of credit unions and banks that will offer you shared secured loans, right? So I'm just going to run through it real quick so everybody understands it. And this actually helps with the type of masterpiece that we're building in that profile. So an institution that offers them, most of the time it's going to be credit unions. It's a shared secured loan. This is where you're able to leverage your own capital. If you have $500, you can go and get a shared secured loan for $500. They deduct the $500 from the checking account. Then they give you on your profile a loan. Now what you do with the $500, you go and pay off 99% of it. Don't pay off the 100% because it now closes that loan out and you don't get all of the variables for an extended time frame. Right? You could get it for 6 months, you get it for 12 months at some institutions. And the more that you have on the shared secured loan, the longer you're able to go. Some even let you go as like far as 5 or 6 years. But anyway, once you pay out the 99%, you're now putting on your profile a 99% paid off loan. So this strategy helps with building out that profile. You see what I'm saying? And the same thing with secured credit cards. Before you go and add credit builders, you go and add secured products with the developing or with the developed bank or developed credit union, that we're looking to access. We're developing a relationship with them in hopes that we go to you in anywhere from, let's just say 90 to 180 days, right? And you're going to give us a chance. In the worst case scenario with the secured credit cards, they may unsecure in 6 months. So while you're going through credit repair, you can go and then get a secured credit card. And guess what? It unsecures in 6 months. You now have a comparable with this particular institution. But anyway, let's stay on point with it. We're talking about the secured credit cards compared to the credit builders, right? The same principle applies to secured credit cards. If somebody has a weak or extremely limited history, I would rather think strategically about the relationships that we're building versus going, I'm not going to say any names, but going to some of these credit builders. I want you to ask, who is issuing the product? Where does it report? What type of account is it? What relationship am I building? Can this relationship graduate? Can it lead somewhere? Because my credit profile philosophy is this: every move should have a next move. I don't want random trade lines. I'm building like an architecture. I want everybody to write this down, right? This is super important here. The perfect profile tells the lender these things here. This person pays obligations on time. This person does not appear financially distressed. This person understands revolving credit. This person has managed different types of credit. This person isn't desperately searching for funding or capital. This person has established relationship. This person has experience. This person is predictable. And the most important one out of everything that I said was the last one, which this person is predictable. Banks price the risk. Predictability reduces uncertainty. And uncertainty is what you're trying to remove before the application. Did I make sense there? Now, I assume that a lot of you tonight are watching this because you're trying to qualify for another personal card. You're ultimately trying to develop the personal profile and graduate to the business. So before we continue talking about the personal data points, I need to address something happening inside of business funding right now, and that's your NAICS code. If you're in consulting, you use 541611, which is, I think is administrative management and general management consulting services or something like that. If that accurately describes your business, then fine. If it does not describe your business, do not use it. Do not select a NAICS code simply because TikTok, YouTube, Instagram, or some funding coach tells you that it's low risk. The NAICS should accurately represent the primary activity of your business. Why? Because your application needs to make sense. Your NAICS code, website, business description, bank statements, revenue, Secretary of State, all of this matters. We want to build a legitimate, fundable business. And while we are building with certain NAICS codes, please understand this. Just because it's a low risk NAICS, that doesn't mean that it's low risk in the form of paybacks. So if an institution asks you for bank statements, tax returns, a P&L, proof of revenue, additional documentation, don't interpret that as funding is dead or they don't necessarily trust you. Sometimes the institution simply wants more evidence before assuming that additional risk. So ahead of time, let's become document ready. This is something entrepreneurs have to understand. If your objective is eventually accessing hundreds of thousands, potentially seven figures of capital, you should expect your business to eventually be examined like a true business. That means the revenue matters, cash flow matters, deposits matter, profitability, debt servicing, existing obligation, the industry, the time in business, the use of funds. Listen, what are you going to the bank and you're asking them for capital for? If you can't walk in there and tell them a legitimate reason and be able to back it up with numbers, you don't have a real business. I apologize if I offend anybody, but it comes a point in business, especially in our community, to where we got to understand this is not just about going out to access more and more capital. The higher you go up, the less this becomes a credit hack. Now, let's put everything together, man. I feel like we spent some good time together tonight. If my objective was to build $1 million and access to capital over the next 36 to 48 months, I wouldn't treat this like one funding round. I treat it like a journey. So phase one, we're going to have a foundation, clean payment history. Let's establish some primary revolving accounts. Let's kind of get that utilization under control. Let's start looking for new banking relationships or building legitimate banking relationships. And then inside of that, let's start getting some great profile age. Let's go and add some personal loans just to make us look more lendable in the next 6, 12, or even 18 months. But stop applying randomly. We don't just add anything. Everything is strategic. We're positioning ourselves, right? From phase one, we'll go to phase two, which is like you want to prove the management. Now that I got access to all of these high limit credit cards, I'm using the cards, I'm paying them, I'm increasing the limits whenever they're appropriate. I'm leveraging my credit limit increases. I'm managing clean history, growing deposits, right? I'm developing business revenue at multiple institutions, not just one. Building internal relationships. And most importantly, we are collecting proof of performance. That's super key. Because proof of performance comes before expansion, which is phase three. Now I'm moving into a little bit more sophistication of products, larger revolving limits. We're getting a 0% business credit cards. We're getting $100,000 to $150,000 in business lines of credit. If it's desirable, this is where term loans were appropriate because we got 1-2 year tax returns. But here's the important part about all of this. We're sequencing. We're not spraying applications everywhere. And I'm going to get into why sequencing matters right here. Because every application affects the next application. Just think about that for a second. If Bank A generates inquiry today, Bank B tomorrow, Bank C Wednesday, Bank D Thursday, Bank E Friday, by the time you reach Bank E or Bank F, they're not looking at the same profile Bank A saw. The profile has changed. You got more inquiries. You got more open accounts, more exposure. So funding is not about where do I apply. It's about where do I apply first? What bureau, what product, what relationship, what exposure do I already have, and have I stewarded this? That's that word again. Have I stewarded this correctly? When should I pay down? When should I request another product? Like all of this is sequencing. And that's how somebody can have an excellent credit profile and still completely destroy a funding round. The trophy ain't about the 800. The trophy is about being able to go and access millions of dollars in credit. Let's stop thinking small with multiple six figures. The goal is to be able to access millions of dollars in credit that where we can leverage it to put our family in an overall better position. You see what I'm saying? So what I want to do now with everybody, right, is I see the chat is going crazy. I want to jump into Q&A. Also real quick, if you want to join my community, I want to give everybody that's here now access to that. So you can text school, SKOOL, to 864-721-8750, and I'll let you guys in. The normal price is $199, but I'll let you guys in for $99. Because like I say, this information must be executed on. We're navigating different from the masses. My goal is to not bring in a whole bunch of people that don't understand this. I'm developing forward thinkers to where we can position our families for, let's just say, $1 million funding sequences. You see what I'm saying? So let's jump into Q&A.